What is happening YouTube? It's Matt Faircloth. Thank you for watching this YouTube channel for the DeRosa Group. My name is Matt. My company is called the DeRosa Group, and I've been in business for like 16, 17 years, investing in real estate full-time. This is the channel that you guys want to go to learn all about real estate investing tactics, strategies, all that cool stuff, multifamily, all that cool stuff is here on this YouTube channel. So stop right here and hit the subscribe button. And thank you for watching this channel. If you guys have a question you want me to answer on the channel, you guys want to email it to us at helpme@derosagroup.com. That is helpme@derosagroup.com. And I'll answer that question right here on this channel for you and everyone else to learn from. So today's question is from Alexander, and it came in from our Instagram channel. And it's interesting that this came in, and there's a reason to mention. If you guys want to follow us on Instagram, you can follow us at the Matt Faircloth. The Matt Faircloth has our Instagram handle. So check us out there. And this one is from Alexander. Thank you, Alexander, for messaging us on Instagram. Hi, Matt. I have a question. I was hoping your input and that you have the time to answer it. I read your book twice. Awesome. Thank you for doing that. That's Raising Private Capital. Correct me if I'm wrong, but the private money loans you speak about are interest-only non-amortized loans, correct? Yes, I speak about interest-only loans, and we'll get to that in a second when I talk about raising private capital, and I recommend that people do interest-only loans when they borrow money from people. I just began reading Brandon Turner's book on investing with no money down, and one of the first private loans he did speaks about an amortized loan. He speaks of a way to find a partner. He's find a partner with the terms of $45,000 loan. So Brandon borrowed 45 grand from somebody at an 8% interest rate. Not bad. 30-year terms, meaning amortized over 30 years. The loan interest rate was $330 a month. Very good. This threw my brain through a blender because I always mention, I don't remember you talking about amortized loans in your book. True, I don't. So the deal that Brandon did is that's very doable. And at a $45,000 loan, that's what you would need to do if you're going to hold the property long term. You can structure a loan like that with somebody who's selling you a property, do seller financing, and you just burn through that seller financing over time, and you want to just pay it off over time, right? One option that you can do, a low balance loan like that, and you amortize it over time. The reason why you might have to do something like that is no bank is going to lend you $45,000. Banks want to lend you, $1, $2, $3, $400,000, if not more. It's hard to find lenders on small balance loans like that. And those are $45,000, 45 grand is a get started property purchase loan. The deal that Brandon's talking about might have been a stabilized rental property where he's able to lay some money down and borrow the rest from a private investor or from the seller themselves. So bottom line, guys, is that you can use the terms that I used and the technology and the methods of obtaining private lenders that I talk about in Raising Private Capital, and you can do amortized loans. The reason why I don't recommend them or I don't talk about them, I would scale up and do a BRRRR strategy thing. I would go and buy a property like that, do some renovations, raise rents over time, increase value, buy it for this, do this much work to where the property, this is your cost basis, but the property will probably be worth this, and I'd refinance it to get all that capital back out. Maybe you can't do that on a $45,000 property, but check this out. You can do a portfolio deal where you buy not just one, but 6 of those, deal after deal after deal after deal. And then you go to a bank and you refinance them as a portfolio. There are portfolio lenders that will lend to you. A small community bank will lend to you, especially if these properties are all in one neighborhood. And that's where we got started in Trenton. A lot of what I talk about in Raising Private Capital are deals that I did in Trenton when I was first getting going. And we would do private loan after private loan after private loan, end up with a loan balance on all these properties of, say, I don't know, $500,000, $600,000, and then wipe all that out with a bank refinance, and you would rinse and repeat. That's how you do small deals using using private money. It doesn't have to be amortized and hold it forever because 8% is a lot, so you could probably borrow money at 4 or 5%. So you could save that difference and keep it for yourself and still amortize it with the bank. I have always treated private money as a hot potato. Get into it and hold it for a short enough period of time because there's cheaper money out there on private debt, right? On the equity side, meaning like if somebody's in your deal forever as a partner and Brandon would have had to have shared the upside with that investor, then it would have been a different arrangement and he would have had to have had that person in that deal forever and ever and ever. Probably not the right deal on a $45,000 loan on somebody. So maybe this is a good arrangement if you're just going to do that one property and amortize it and hold it forever. Maybe that works. It probably would have worked even better to scale it up or to bring that $45,000 investor into a larger deal and have them sit as equity in the deal. Long answer to a very short question, Alexander. Thank you for asking that question. And it's a good way. It's a good question because it really talks about when to use private capital, when to go to a bank, and how to structure private capital. Bottom line, guys, don't ever structure a private capital deal without knowing exactly what your exit is. In Brandon's deal, pay it off. You just want to your exit is to just amortize it and pay the investor off, hopefully less than 30 years, by sending some extra money to them over every month and paying them off. Right. That's one way to do a private loan deal. You could have refinance or sell it on a BRRRR, a fix and flip, or on an equity deal. Have your exits lined up, whether that be through refinance the investor out, sell it, or buy them out over time or something like that. Okay. There you go, guys. Help me at DeRosaGroup.com, or as Alexander did, send a message to us on Instagram, and we'll answer your question right here on YouTube. Thank you, Alexander. Thank you guys for watching. I appreciate you. Make sure you check us out at DeRosaGroup.com if you want to hear more about what we do. Have a great day. Have a great and profitable week.